Welcome to the Bucket Plan on Demand, a podcast for financial advisors based on the best-selling book and process that simplifies financial planning. Hear from skilled industry professionals and special guests each episode that will help perfect your approach with clients and your results.
It's really a treat for me to be invited here to speak. I've met so many of you over the years. I know you're outstanding financial advisors, and I love that we share ideas together and help each other grow our practices. But just before I start, by a show of hands, how many people in this room have done Social Security workshops or feel they understand Social Security pretty well? A good number of you, right? All right. So hopefully today you can pick up a couple of gems that can help you grow your practice even further. But for those who aren't doing Social Security planning, it is a gold mine as far as prospecting. For our firm at OneTeam Financial, we target people who are approaching retirement or in retirement. And guess what they want to talk about? Social Security and Medicare, right? So we want to get those introductions. Now, our CEO, Dave Buchwald, is also our visionary. And he said, the best way to help people who are going into retirement and through retirement is to have a team of specialists, a team working for those clients. So at our firm, of course, I do the Social Security. Rich Gustafson does our Medicare. When it comes to life insurance, long-term care, Dave Buchwald, Drew Surzan do that. Investment planning, retirement income planning, we have the great Greg Dillon, Greg Schulman, Steve Benny, superstar Steve Benny. But the point is, we don't do it all ourselves because you can't do a deep dive in every area. You just can't. So when we decided to do Social Security planning, one of the things we were concerned about is, how do we find prospects? And I can tell you this, I do not do public workshops. I have no interest in standing in front of a room of 100 people who I don't know them, they don't know me, I don't know what their net worth is, I don't know anything about them. What I want is professional referrals. I want referrals from centers of influence, CPAs, attorneys, other professionals, because the people that hire them and pay them fees to do planning, these are serious people. And when you get a referral from a CPA or an attorney, that's an entirely different introduction. If the CPA or attorney hired me to do their Social Security plan and they're telling their client, I can't help you, call this guy, right? That's a powerful referral. And guess what? If you can get an army of CPAs and attorneys who know who you are, and when Social Security comes up, they're like, I got a guy. You want to be that guy. Now, if a client says to an attorney, CPA, who do you know who sells life insurance, long-term care, investment management? They got like 10, 20 people. Who can help me with Social Security? Right? You're the guy. So the idea, of course, is to bring them in, but once you get them, you got to convert them into other clients. So with my background, I'll ask this client, what did your referral tell you about me? They said, oh, well, you're the Social Security guy. And I said, all right, well, let me tell a little bit more about my background. And I tell my background. I said, there's a good chance when I go through my 9-page questionnaire with you, I'm going to identify opportunities for you to save money on taxes, lower your costs on your insurance, find affordable long-term care solutions, address your estate tax planning, talk about Roth conversions, bracket bumping, all the great stuff we learned at Tax Management Journey, right? But now I have permission to bring that up when I'm doing that questionnaire. And when they say, yeah, I just had a client yesterday, just true case. My colleague, Drew Surzan, he gets referred from a CPA to a person who's looking for Social Security advice. Drew's not going to try to figure out Social Security, he's going to bring me in. I do the questionnaire with the client, the preliminary call. He's worth $25 million. He's got an estate tax problem, right? He's about to retire, just sold his business. He's interested in long-term care. He has an insurance trust with no insurance in it. This is great. Now, how do we get that guy? Not because the CPA says, oh, I know somebody can help you with life insurance or long-term care. It says, I know somebody can help you with Social Security. So that's how we go about this practicing. Now, the other thing we do is we charge fees. Everybody here should know what their price per hour is. How much do you charge an hour for your time? How much do you charge an hour for your time? You gotta charge for your time, don't give it away. One of the reasons we charge a fee, and I'll just throw this out there, we charge $2,500 just to do Social Security, and that's our discounted fee. I want serious clients. I want people who take professional advice and are willing to pay a fee to get it. So what does that mean? What that means is I say, look, if I didn't exist, what were you going to do? And they tell me. I've never had a client end up doing that. There's always a better solution. And I'm going to go through some specific examples on how that works. So again, that's just how we do it. I'm just saying, as a professional firm, you're trying to filter out clients. People who aren't willing to pay you a fee are probably not clients who are going to take your advice. Okay, so for us, it's a filter. Myths on Social Security. Oh my goodness. The amount of misinformation out on Social Security is off the charts. I did the governor of New Jersey's plan, missed thousands of dollars. These are successful, wealthy people with the best advisors in the country, but not in Social Security. And for a lot of people, not those people, but for a lot of people, Social Security is probably their largest retirement asset, and they've never looked at it, and they don't know how. It's stunning to me. When we do retirement planning, Greg might have a retirement plan account. We say, send us all your stuff, your investment statements, insurance. They send us everything but their Social Security statement. They don't even know how to get it. So the amount of money that Social Security pays these people blows their mind. They have no idea. So that's what we work on, being that reliable referral source. Now, I know most of you who do Social Security planning understand this chart, right? Full retirement age. Why am I even showing you this? I want to show you as an example about how complicated Social Security is. Now, for those of you who don't know, you look at the year you were born. So let's say you're born in 1956. Your full retirement age is 66 and 4 months. What does that mean? That means if you choose to file for your Social Security when you're 66 and 4 months, it doesn't matter how much income you earn. You can make $1 million a year and collect Social Security. But any time prior to that, 62 to 66 and 4 months, if you make more than $22,320, every $2 above that, they take back $1 Social Security. Social Security makes nothing easy. Not even this chart. Look at that chart. Look at that person born in 1956. Is it possible that person has more than one full retirement age? Anybody here born twice? Well, she does. Why is that? Because she's a widow. She's still working. She's 65. She says, when I turn 66 in 4 months, I'm going to keep working. She has a 6-figure income. I'm going to file for my survivor benefit then. I'll get 100%. I'll defer my benefit to 70, and then I'll get my max benefit on my own. I said, but you don't understand. There's a different full retirement age for survivor benefits, right? For someone born in 1956, it's actually 66. So she's going to miss 4 months of checks, which in her case is over $12,000. Not going to change her life, but the point is Social Security is not going to send her a letter and say, hey, by the way, come on in and get your money. That's not how Social Security works. They make nothing easy. If you take your benefits early, you get a reduced benefit, right? The earliest you can file for a retirement benefit is 62. What's the earliest you can retire or file for a survivor benefit? 60, unless what? Unless you're disabled. Then it's what? It's 50. If you delay, Social Security guarantees to increase your benefit amount by 8% a year. So if you wait to 70 compared to 66, you know your check amount's going to be 32% higher. So should you always wait to 70? I'm going to say almost never. I don't know if I even have a single client where both spouses wait to 70. I've never seen that be the best. In fact, I'll say something even more dramatic than that. The strategy that pays you the most money is never the best. You're going to say, wait a minute, isn't that why they hired you? No, they didn't hire me to do that. They hired me to find them the best strategy. I'm going to refer to a specific example later, but just remember I said that. When I was first in the business doing appointments, and it was a life insurance appointment, there was a good chance it was getting canceled or they were going to be late. When I started booking Social Security appointments, they confirm with me and show up early because they're coming to get money. It's a good story. This is what you hear in the press every day. Social Security is going to run out of money. As soon as you can, race in there, go get your money, right? Why are they saying that? Well, they're saying that because the Social Security Trust Fund is projected to run out of money in 10 years, right? 2034. So what happens? They're collecting their Social Security check. It's 2034. They flip on the news and they say, the Social Security Trust Fund just went to zero today. Do they get anything? What happens to their check? they still get about 80% of their benefit amount, because most of the money funding Social Security doesn't come from the trust fund. It comes from tax receipts. And that's if they make no changes. You know they're going to make changes. They have to, right? What can they do? Well, one of the easiest things they can do is push the full retirement age up from, say, 67 to 68, 69, 70, right? I remember when Governor Christie was running, he wanted a 20-year transition from 67 to 69. Here's the good thing about pushing the full retirement age up. If you're running for president, you go into Florida and you tell them you're going to cut Social Security, not a good idea. You tell a 20, 30, 40-year-old, you're not getting your money till 69 or 70. They're like, whatever, we don't think we're getting anything, right? But actuarially, that'll push the trust fund out 20 years. Just that. They could put a cap on the cost of living or eliminate it. Very, very rarely will you ever find a pension that has a cost of living increase rider. It's too expensive. Only the government can do that. So they might put a cap on it or eliminate it, or increase the taxation of Social Security, or increase the taxable wage base, right? What's the taxable wage base on Social Security right now? $168,600, right? But on Medicare, it's on all your income. So why wouldn't they raise the tax rate? They have a lot of levers to pull. Social Security is not going away. Are they going to change it? Probably. They're means testing Medicare right now, right? Maybe they'll means test Social Security. They could do that. Warren Buffett collects Social Security. I think he could live on 80% of his check. Just saying. All right. Once you file, you can't change your filings, right? It's permanent. Pretty much, but not exactly. Social Security will give you up to 12 months to pay them back all the money they paid you, and you can get one do-over. But after 12 months, you can't change it. Why is it important? A lot of times I get referred to a client and they said, well, my husband filed 8 months ago, but I haven't filed. So now I know I still have all my options on the table, right? But let's say it's been past 12 months. Is there anything else you can do to change your benefit? Between full retirement age and 70, at any time you choose, if you're collecting Social Security, you can have Social Security suspend your check. Stop paying you. Why would you do that? Because as soon as they stop it, it's going to start growing again at the rate of 8% a year. So if my client filed at 66, at 67 he got a consulting job for a year. He goes, you know, Ash, I'm getting $200,000 for this year. I don't need my Social Security. I'll suspend it from 67 and turn it back on at 68. It'll be 8% higher for the rest of my life. You can do that. Do you have to suspend for a whole year? No, you can suspend for 6 months. It'll be 4% higher. 2 years, 8% higher. You can turn it on and off, but you cannot suspend prior to full retirement age. Between 62 and full retirement age, you can't say, geez, I filed at 62, I went back to work at 65, I'll suspend Social Security. You can't do that. The earnings test will kick in, but you can't suspend your check. I want to get to people before they turn 62. I want all their options in front of me. But sometimes it doesn't work out that way. But just understand. And sometimes it's counterintuitive. I had a client, he was a doctor, filed at 66, called me at 68, and he said, Ash, I just found out I have terminal cancer. I said, how much time are they giving you? He goes, 3 or 4 years. He goes, I'm thank God I filed for my Social Security, but what should my wife do now? I said, well, forget her right now. First thing we're going to do is stop your check today. They said, why would you? I got another 3 or 4 years to live. I can get those checks. I said, you don't understand. If we suspend your check today at 68, turn it back on at 70, it'll be 16% higher for the rest of her life, because that's going to be her survivor check. So she's going to get 20 more years, right? It's counterintuitive. You think if you're sick, get as many checks as you can. Not necessarily. Not if your check's the higher amount. Spousal benefits are no longer available. I hear this all the time. You know, they got rid of filing and suspending a while back, right? Somebody asked me earlier today at lunch. They were like, I used to do Social Security, but when they got rid of filing and suspending, a lot of the strategies went away. I said, you know what? My business quadrupled. Because now it got rid of all the people who knew sort of a few rules, and now you have to do some real sophisticated planning. So the spousal benefit that went away was the one that said you could collect half of your spouse's benefit, defer your own, and then turn your own benefit on at 70, right? Collect off it. Well, you can't do that one anymore. But the other spousal benefit's still in play. And I got to do some math here just to sort of illustrate it. When you determine what the spousal benefit is, you have to compare each spouse's benefit at their full retirement age. So for simple math, if a husband and wife full retirement age is 66. And the husband's PIA, their benefit at 66 is $3,000, and the wife's is $1,000, right? She's entitled to what? The greater of her own or half of his. Well, half of his is $1,500. So she's entitled to $1,500. What she's really entitled to is her own $1,000 plus a $500 spousal add-on. The reason I break them apart is she can't get that extra $500 unless her spouse is collecting. So here's what I run into a lot of times. This doctor says to me, you know what? I don't need my Social Security at 66. I'm going to wait to 70. Instead of getting $3,000 at 66, I'll get $4,000 at 70. Then my wife will get half of the $4,000. No, she won't. She can never get more than half of what he would have gotten at full retirement age, right? So he would have wasted not only 4 years of his own check, but he's leaving money on the table every month, right? Because his check triggers 2 checks, his plus the spousal check. By the way, this applies for ex-spouses, right? If you're married for 10 years or longer, all the rules you need to collect off an ex-spouse, you can collect a benefit equal to your own or 50% of theirs. What's the difference? It's better to be divorced. Just saying. Why is that? Because for the spouse, the married spouse to collect the spousal, her spouse had to be collecting. What's the rule for divorce benefits? They have to be divorced for what? 2 years or longer. But if the ex is collecting, then you don't have to wait the 2 years. I just had this case. A divorce attorney called me yesterday and said, bad divorce. The husband refuses to file for Social Security till 70 because he doesn't want his wife to get any more money. I said, it doesn't matter. Once they've been divorced 2 years, she can collect off it, right? So you need all these nuances. When they say there's like 2,700 rules in Social Security, there's like 6 rules and 2,700 exceptions, right? It's all about the exceptions. All right, your marriage has to last 10 years to qualify for a survivor benefit. This 10-year rule confuses everybody. Everything's 10 years, 10 years, 10 years. What's the rule for survivor benefits? Yeah, have to be married for at least 9 months, right? Unless what? It depends, right? I want to know how the guy died, because it matters. Your marriage has to last 10 years to qualify for an ex-spousal survivor benefit, but not for a spousal survivor benefit, right? All right. If your ex-spouse remarries, you can't collect benefits off him. It doesn't matter that he got remarried as long as you didn't get remarried. Him getting remarried is his problem. You're still good. All right, so the remarriage of the ex-spouse, not a problem. If you're entitled to ex-spousal or survivor, you're still good, as long as you didn't remarry. However, if you did get remarried, can you still collect off the ex-spouse? Well, you can't collect ex-spousal, but if you remarried after you turned age 60, you could collect. This is serious stuff. This is serious stuff. I'll give you 2 examples. I had a client, the husband, or the boyfriend is 63. He's a widow, already collecting off his former spouse. His girlfriend's 59. Her former spouse is deceased. When she turns 60, that's the earliest she can file for the survivor benefit. The problem is they want to get married. They said, Ash, can we get married? I said, no, not yet. I said, if you get married now, when you turn 60, you're no longer eligible to collect off that former spouse. But if you wait till you're 60, then get married, you can still collect off that former spouse, right? So remarry after 60. I ran into a couple, they were 67 and a half, both of them. They were delaying their benefits to 70 to max amount. I said, were either of you married before? Yes. Are your former spouses deceased? Yes. I said, that's great news. But I need a little more information. How old were the 2 of you when you got married? Turns out it was 60 and 3 months. 60 and 3 months. Those 3 months, because they got married after 60, amounted to over $300,000 in survivor benefits off a former spouse. But they would have missed all of it. They were just deferring their checks to 70. They didn't even know they could collect off the former spouse.
Can you take a question real quick? For the surviving spouse under the survivor benefit, is that litmus tested by income?
Yep.
It is income.
Yeah, anytime you collect any Social Security benefit, survivor, retirement, whatever, it's subject to the earnings test. Yep. Okay, can you backdate the start of Social Security without restrictions? You can only backdate filing if you're past full retirement age. So 62 to full retirement age, you can't go in at 65 and say, I want to backdate to 62. You can't backdate one day. Between full retirement age and 70, you can backdate the greater of, or rather the lesser of, 6 months or full retirement age. So if your full retirement age is 66 and you're 67, you can backdate to 66 and a half. If you're 66 in 3 months, you can only go back to 66, right? So that's the only time. Now, should you backdate an application? I can't tell you how many times it makes the most sense to do it. It's unbelievable. My clients that are 67, 68, 69, I rarely see a scenario where backdating doesn't make sense. You still have to crunch the numbers, okay? But here's some of the goodies that you can get. Let's say my clients are 68. The husband's thinking, should I file now at 68 or backdate to 67 and a half? His wife's already collecting, but her benefit's less than half of his. She's entitled to a spousal benefit, which he couldn't collect because he hasn't filed yet. If you backdate in the scenario I'm going to give you, and I'm just going to give you the numbers, backdating, he would get about $16,000 lump sum. His check will be 4% less. But when because he backdated 6 months, she can backdate the spousal 6 months, right? Because she's allowed the spousal as soon as he collects. Well, he backdated. So she can get missed spousal benefits. He can get his own missed benefits. Combined, they get over $18,000 lump sum. The break even was well into their late 80s. Are you kidding me? Do it every time. You got to run the numbers, but a lot of times backdating makes total sense. I had a client, he says, Ash, I don't even know why I'm calling you. My accountant said, don't do anything till you call this guy. I said, all right, well, what's your situation? He goes, well, my wife's 73 and collecting, and I'm 69 in 10 months. I said, so what's your plan? He goes, what do you mean, what's my plan? In 2 months, I turned 70. I'm going to file. I said, worst thing you could do. He said, really, what's better than that? I said, pay me and I'll tell you. So he did. Why did he do it? Because his accountant said, do whatever this guy tells you. So he paid me. And I said, all right, I want you to backdate immediately, 6 months. Your wife's going to backdate for missed spousal. They got about $40,000 more up front and gave up $18,000 in 22 years. Who cares? Take the money. All right. Oh, I love this one. The Social Security filing strategy that pays the most is the best. It never is. It sounds crazy. I know, it sounds crazy. But here's why. Actually, well, okay, I'll tell you the story later. Here's why. What is Social Security? It is a guaranteed lifetime pension, but it's a guaranteed lifetime potential pension. You don't know how many checks you're going to get. I tell my clients, oh, my benefit's $3,600, my wife's is $2,800. Really, if you get hit by a bus yesterday, Social Security keeps the $2 million. Right? So you're more likely to get the first 5 or 10 years of checks than the last 5 or 10. So you have to risk affect those cash flows. In my software, I'm going to plug most scenarios. We're going to run 567 filing scenarios for a couple. The first one I'm going to look at is what pays the most. Why? Because I know I'm not picking that. But I have to benchmark it against something, and all my clients want to know, how do I get the most? I'll say, look, here's how you get the most. There's no way to get more money than that. What I want to do is actually get you less money, but more up front. I want to give up about $90,000 in 25 years. Why? Well, what's the net present value of $90,000 25 years from now? 20, 30 grand? What if you don't live to 90, right? You may not even get it. But if two cash flow streams have the same net present value, or virtually the same, which one's better? The one that pays you more up front is better because it's more certain, right? So plugging and chugging the numbers to get the most. Dave does an outstanding job with KPMG. We got all these top tax partners, really premier tax partners. I had one partner who said, Ash, I don't even need your help. I got my own spreadsheet. I did the whole thing, blah, blah, blah. I know the rules. I put cost of living in there, everything. But I'll pay you just to confirm I'm right. I said, there is 0 chance you're going to be right. He goes, you haven't even seen my spreadsheet. I don't need to see it. It's going to be wrong. He goes, will you look at it? I said, no, you're wasting my time and I'm wasting your time. He goes, just like I said, fine, send it to me. He calls me, he goes, so what do you think? I said, hit delete. Immediately. I said, look, I went to Wharton. I know what you're trying to do. You're trying to maximize the value of this future cash flow, right? It's not about that. This is a potential pension. Be smart about it, right? And once you see those numbers and you look for what I call the sweet spot, I think every couple has a perfect filing strategy, and I've never had a single client figure it out. You've got to run side-by-side cash flows. I want the most amount of money up front, but intentionally give up some money down the road. That's your best strategy.
Thanks for tuning in to the Bucket Plan on Demand, brought to you by C2P, an organization whose purpose is to educate, train, grow, and support holistic financial advisors so families can achieve true prosperity. Subscribe today for the latest episodes and insights. Visit c2penterprises.com to learn how we can help support and enhance your advisory business. At the time of delivery and any subsequent publishing, information was deemed reliable, but is subject to change by the time of listening or viewing. The contents of this piece include options and projections of C2P, are subject to change, and are for informational purposes only. The information provided in this presentation is not intended to be individual investment, tax, or legal advice.